Ladies and gentlemen, welcome back to my YouTube channel. My name is Witubelibakobashane, the creator of the Be Smart Budget, your sustained budgeting, and of course the self-appointed personal finance activist. So let's talk about car loan, which is known as vehicle asset finance versus personal loan. So which one should you go for? What is a car loan? A car loan is you getting financing through the bank to finance a car specifically, and this kind of loan is secured, meaning that should you default on any payment, the loan is secured against the asset, which is the vehicle. And then there's a personal loan. A personal loan is a loan where you can take you can take it out and buy anything using it. You don't necessarily have to buy certain stuff using that loan. And there's two types of personal loans: the unsecured and the secured loan. The secured loan also works like a personal like car financing, which is attached to something. It's a loan that is attached to an asset, but mostly banks do not give out secured loans. They often give out unsecured loans, which tend to have a very high interest rate because the bank needs a cushion for them should you default on their payments. So what is the pros and the cons for a personal loan? The cons is that, now remember, I'm stating the cons of when you are buying a car using personal loans, nothing else. So the cons will be along the lines of a vehicle. And so the first pro is there's no restriction to funds that are used. So you can apply for however much you can afford, and you don't necessarily have to buy a certain car, but you can buy the car of your choice because you have the funds available to you. Payment structure is flexible, so there is short term and there is long term. And then the ownership, you have ownership of the car, and there is no repossessions. Should you stop paying or you default or lose your job and you are in a state where you can no longer pay your monthly personal loan repayments, you then your vehicle does not get repossessed. And then what are the cons for a personal loan? The cons is that the interest is likely to be very high, because remember, this is an unsecured loan. The bank knows that should you stop paying, they're not going to get their money back. So they make sure that the interest is high, and they make all their money whilst you can still they make all their money back whilst you can still pay. The lending requirements for a personal loan are quite difficult, so there's a lot of things that they look at for your loan. So I am going to list a few of these requirements. The requirement is a great credit score, a loan a debt to income ratio, and the loan value ratio. So those are the things that they tend to look at when you are taking out a personal loan. And then a consumer with credit scores poor credit scores won't qualify. As I have mentioned above, that these are the requirements that you have to they look at. The things that they look at, one thing is your credit score, and you know that when you're taking out any form of credit, your credit score is very important. And then now we move into car loans, which is your vehicle asset finance. What are the pros? Usually the interest is lower because it is a secured loan and the bank has attached this loan to your vehicle. So should you default, they come and fetch their car. And it's easier to obtain. Usually, even if you have a not so really good credit score, you can still get a car. It is not hard to get a car. And then the cons are you do not have the title of the car, which is the problem. Should you lose your job, as people often say that it is the biggest problem, because how would you feel losing your car? And should you lose your job, the bank comes and they take their car, and then you usually require an upfront deposit, especially if your credit score or your affordability is in question. Then you need a deposit. So when you are going for a car financing, what do they look for when they calculating your interest, or what do they look for before they give you a car? Is that they look at your credit score, they look at the car loan the actual amount of the loan that you are looking for, and they look at your income in order to be able to suss out your affordability, to tell whether can you really afford the monthly. That con is that usually if you do not have a deposit, you have to take a balloon payment. The bank offers you a balloon payment in an instance where you do not have a deposit, and the car that you're wanting, there's a bit of a difference between your affordability and the car price. So yes, so here's another thing that, guys, we often overlook as individuals. So I think, as we do not necessarily read more into it, but do you know that the term for the personal finance and the term for personal loan and the term for the asset vehicle finance is the same? You have a dashing credit score and you have great affordability. You can take for a loan for 36 months, 48 months, and 72 months. It all depends on your personal capacity to pay back the loan, or your affordability to pay back either loans. You can choose, well, even with a car, because I did a TikTok about this topic, and I found that a lot of people are saying, but a car finance is longer, you pay for 7 years, and but if you can afford more than what if you can afford the car very well, you can choose any term that you want to go with. You don't necessarily have to go for the 72 months term. It is up to your income, your expenses, the loan amounts, and your affordability. And then with a personal loan, you find that the shorter the period, the higher the installment. So those are the things that you need to look at before you make your choice on whether to go for a car financing or for personal loan. But I would personally go for a motor vehicle finance, because if I can avoid paying twice as much as I should for something, and there is other alternatives and there is other options, I will definitely look at those options. And then when people say your car will get repossessed, this is why, guys, we emphasize, when we are talking about personal finance, we emphasize that you guys have an emergency fund. So should you find yourself in a situation where your assets are at risk of, you are in a risk of losing your assets, you do have a 3 to 6 months emergency fund to cover yourself, so that you are, for the first 6 months while you are out of a job, you are still paying your bond, you are still paying your car, you are still eating, because now you have a 3 to 6 months worth of living expenses put aside. So that is why we always emphasize the importance of an emergency fund. So if you tell me that, no, I will take a personal loan because my car won't get repossessed, and when I stop paying, rather take a vehicle finance, and then you know that the extra money that you have, you pay towards the loan. When you have the extra money, it decreases your interest, and then you build up a 3 to 6 months emergency fund to stop the stress. So that is why I say, for me, the best option, it's between the two, it's vehicle finance, a vehicle asset finance. But anyway, yeah, that is all from me today, guys. If you found this information valuable and you haven't clicked on the subscribe button, please click on the subscribe button. Please leave a comment down below for me, and do not forget to subscribe. I will definitely see you on the next video.